Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. This week, I wanted to share with you some issues that I come across in general planning and almost take for granted, but then I realized this type of planning is probably not being done by many of you. And what it is it's a little bit in depth. When people get into retirement years or thinking about retirement, we have to start thinking about income. What I mean is income alternatives. You have a paycheck for all of your life. Once you retire, you don't have a paycheck for all of your life anymore. But your paycheck was dependent on your health and your ability to work. Your paychecks in retirement are not necessarily dependent on your health or ability to work. So what you have is a potential of sustainable income, but it depends on where it's coming from. Well, when we dive deeper in income planning in retirement, we get to a situation where we go almost so far as legacy planning. So we're looking at, number one, do you have enough money to retire? Number two, where's the money going to come from for your income? They're two different issues. So I hear a lot of people say income planning in retirement, income planning in retirement, income planning in retirement. And I look at it and say, wait a minute. Asset planning in retirement, asset planning in retirement. So I look at that and say, if you have enough assets, you don't have to worry about risk. It's when you don't have enough in assets and need income from those assets to provide for you that sometimes you have to take risk and earn higher rates of income to be able to sustain your lifestyle. Higher percentages. So you look at this, if you had enough money, you would not need to be taking risk and chasing higher yields as if you don't have enough money. So it's all a function to me, in some cases, of assets. The other side of it is indeed income, where you have Social Security income for you, Social Security income for your spouse. You look at the situation of if you have any pensions, and then if you have any investable assets. Whether they're fixed assets or in the markets, they're assets. So we look at this, and when I see different stages in retirement, you probably plan when you retire, do I have enough to retire? Here's how much I need a month. Okay, we'll retire. I, as a certified financial planner, see through retirement, not to retirement. And the difference is, there are different stages in retirement, just as there were different stages in your working years. The different stages in retirement are different for everyone. Some people are very active and healthy, and some people are very inactive while being healthy. Others are not healthy enough to travel. And sometimes you're healthy enough, and then in later years are not able to be healthy enough. So a lot of people will make the mistake when they communicate to me, we want to spend our money early in retirement or more money early because later we won't be able to. There's some truth to that in some cases, but the problem is with increased health issues that might prevent or preclude your ability to travel as much and enjoy golf and sporting activities, different things in retirement as much, the health concerns could drain the assets at a faster and higher pace than those enjoyable activities. So you have to be careful if you're looking at, well, we want to spend now because we might not be able to later. You may need those assets later to help provide the standard quality of life that you need. But now that you have 23 prescriptions you have to take every day, some of those are $1,200 a month. Some of those are $20 a month. But whatever it is to keep you alive that the doctor prescribes is what you're going to have to find a way to pay for. Wouldn't it be nice if you had a highest quality of life you could possibly provide yourself because you protected your assets in retirement and didn't frivolously or squander those assets early to the regret of you later? Well, there are other concerns even deeper than that when I look through retirement rather than to retirement. And here comes some of those. We get a situation where somebody says, I'm 70 and a half and I have to start drawing from IRAs. Now that increases typically your tax bracket because it increases your, not your bracket, I shouldn't say that, it increases your taxable income. So it has the potential of increasing or forcing you into a higher tax bracket, but maybe not. It also has the potential of forcing you into a higher taxable portion of your Social Security. What I mean by that is Social Security income is not taxed until you earn certain levels of other income. So if you have other taxable income, or all sources of income actually count to your Social Security being taxed. When those levels get too high, then up to 50% of your Social Security counts as taxable income. When those income limits get higher, and it's different for singles than married couples. Let's say you're married and your income, taxable income, even tax-free income counts into the calculation, exceeds $44,000, and they count half of your Social Security and your other income that counts on your estimate, your Social Security estimate worksheet. And every one of you can get a copy of that and work it out for yourselves. But you might find that that extra RMD coming from your IRAs pushes you into the bracket where now up to 85% of your Social Security could be taxed, where prior to the RMDs, only 50% of your Social Security was being taxed. It can also push your Medicare premiums up. So it's a little bit complicated here, folks. When we look through retirement, we sometimes look at strategical sources of where to get that income. And that's where this show is going today. Are there strategical alternatives that you should be considering for tax purposes included? Most people don't think of the different tax alternative methods of structuring income in retirement. But what you do is you look at IRAs, traditional IRAs. Any money taken from a traditional IRA is fully taxable as ordinary income whenever it's taken out. If it's not taken out, well, whether it is or is not taken out prior to age 70 and a half, it is required that at least a minimum distribution, not all of it, but a minimum distribution every year is started by the time you're age 70 and a half, typically. It's more technical than that, but that's a good general explanation. What about other forms of assets? Because most financial advisors, now a certified financial planner typically might go a little deeper, but most financial advisors say you would touch your IRAs last because that's fully taxable income. I look at that and say I'm not so sure. It depends on your personal situation. We look at a number of different other alternative classes. One might be you might have mutual funds, you might have stocks, you might have money in bank CDs, you might have money in 401k accounts, you might have money in Roth IRA accounts. So let's explore this. You might have money in variable annuities or fixed annuities. The tax ramifications of drawing from each form of those assets is different. So I'm going to touch on this to show you how complicated this can be, but how beneficial this type of planning can be, not only to you, but to your heirs. So when we do income planning in retirement, we might look and say a simple statement. How are your kids doing financially? And I might get the response, my kids are struggling. And I might also get the response, my kids are very well off. So if I get the response, they're very well off, and I ask the client, you're retired and only on Social Security other than your assets, right? And if they say yes, I might say, you're in a pretty low tax bracket. You have preferential income only half of your Social Security is taxed, or maybe none of it right now if you're living only on Social Security, and if that's enough to pay your bills for you and your spouse. So if that's the case, I might say, you know what, that IRA that's looming, once you start taking it 70 and a half, it's going to force some taxable income out. That's true. But have you ever considered, I might ask, starting to draw from that IRA now, instead of, if they're coming to me to ask me for more income, and they're thinking take it out of the non-qualified accounts because it won't be taxable, let's say, for example, I might say, why don't you pay a moderate tax now? Because your kids who are well off are probably in the 28 or 33% tax bracket, and more likely, you're probably going to find a situation where taxes are going up in the future. If that is the case, if the Congress continues to pass tax increases, your children may, if they inherit your IRA, be forced to take RMDs if they do the stretch IRA. And if they have non-qualified annuities, the annuities have to be cashed out and the tax paid all at once on the gain, while the deferred gain on a tax-deferred annuity is all at ordinary income. So if that's dumped on your kids, your wealthy kids or well-to-do kids, that might push them into a tax bracket where 33 or 35% of the income is lost to taxes. Whereas if you took out the income, maybe only 5% would be lost to taxes. Do you see where I'm going with this? This type of planning is deep, but this type of planning is very valuable because sometimes you can lose a lot of money in not doing tax planning, more than in many other areas. So we look at this and we say, what if you're tax efficient? What if we look at tax efficient income? Coming out of annuities, it's possible to pull out money on an exclusion ratio, we call it, where it's always part principal, part interest, every payment. Other situations, when we pull out of annuities, they're tax deferred if they're not IRAs. It's all interest first, which means it's income, all ordinary income for every check until you've exhausted the earnings or the interest or the gains, and then gets into your principal. There are planning opportunities with both, folks. Some people will say the exclusion ratio is more beneficial. I might say the ordinary income might be more beneficial in some cases. Those cases might be just as I explained. The person being in a low income tax bracket in retirement, the heirs, even the spouse receiving the the annuity, the non-qualified annuity as a beneficiary, it might have to be all cashed out and all of the interest earnings might be taxed all in 1 year. Folks, that's unforgivable. If we've not done tax planning in advance, we've just hurt the spouse by saying if we took that income out and skimmed it off the top for a 5 or 10 year period, rather than waiting for a survivor benefit, they might not get that annuity dumped on them, which needs cashed out. Half of the annuity might be gains, and here your spouse gets a whopping tax bill, 30%, and next year your spouse is back down in the 5% bracket. Why? Because we didn't do advanced tax planning. So when we do income planning in retirement, this is tricky. You'll see some advertisements on the radio. I hear them a lot. Guaranteed rates of return, interest 7%, 6%, whatever. If it sounds too good to be true, it normally is too good to be true. So what I want you to realize and remember while you're listening to these ads are, sometimes you need to ask the question, is my income coming at the expense of my assets or my principal protection? And is my principal at risk for you to generate that income if the investments are not producing that rate of return? Are they taking that money from your principal? So anyway, back to this tax planning. You see how complicated this is. You could feel it as I speak. But the issue is a revelation. We sometimes say, okay, Jack, why don't we do this? why don't we look at our traditional IRAs, which we now in retirement wish we were never in sometimes, because all it is a tax time bomb for me or my kids, or my heirs or my spouse. The spouse typically gets to inherit an IRA and stretch that, only required to take required minimum distributions. The non-qualified annuities, not the same benefit that's being provided to the spouse in many cases. How about your mutual fund accounts? Well, your mutual fund accounts have capital gains, capital losses, ordinary income, dividend income, and qualified dividend income. Folks, that sounds like a mess because it is. It's complicated. The mix of taxability on the mutual fund accounts is very convoluted and complex. You can use this as a strategy, though. The problem with the mutual fund world for the taxes are you typically, the account holder, cannot control when taxes are incurred. If you own individual stocks, you can control when that stock is sold. The capital gain is incurred when you liquidate the stock. So while the stock goes up and down in value, you have unrealized gains and losses, but not realized until you sell. If the stock's down, you have a realized capital loss. If the stock's up, you have a realized capital gain. It's either a long-term capital gain or a short-term capital gain or loss. You also have dividend incomes from some stock. That can be qualified income, which is at the more beneficial rate in some cases, or ordinary income, ordinary dividend income. So you look at this and you say, wait a minute. In stocks, if I control when it's taxed, is that different than in a mutual fund account where I don't control when it's taxed? Yes, folks, it is. And especially when we get to legacy planning. So when I look at these wealthy kids, let's say, and we say, we don't want to hurt the kids. We want them to receive the majority of our money. We don't want to pay the government. Most people tell me, I don't want to pay the government more than I have to. So what we do is we try to apply strategies and we say, guess what? If you own the individual stocks and you didn't liquidate them and you let them keep growing, and if they did keep growing, all taxes for the capital gains under current tax law are waived upon inheritance, upon death. So you beat the government. Your mutual funds are that way too, but the mutual fund managers keep trading and exchanging and swapping your stocks and bonds inside there. So you'll see a turnover ratio of 30 or 40% in your portfolio. That means typically they're trading in and out of 30 to 40% of your holdings. Every theoretically 2 years, 100% of your portfolio is turned over. So you're getting pummeled on taxes sometimes where you don't need to do that. It's up to you. You have to talk to your CPAs. You have to get to certified financial planners working with CPAs, and let's bring up attorneys. Now we get to the attorneys and we say, what's our situation? Well, here's what your situation usually is. Number one, do all your beneficiaries match? Is the money going to the right people? Number two, are your beneficiaries set up with the right assets going to each beneficiary? You might choose a third, and a third if you have 3 kids. But most people simplify that incorrectly by not doing tax planning. A third of my IRA, a third of my Roth IRA, a third of my stocks and bonds, a third of my variable annuities, a third of my mutual funds, and a third of my CDs, and a third of my house. Folks, that's almost always wrong. Because the type of assets, if the IRA is inherited by a low-income recipient, it's more beneficial. And if an IRA is inherited by a very high-income child or heir, it's very detrimental. That child could receive a different set of assets that would not have burdensome tax consequences. And the one with the IRA with a low income tax might be able to receive the IRA and only be taxed on 5% of it themselves, as they're required, if they do the stretch provision or beneficiary IRA, they might only pay, in essence, about a 5% tax on that. So if you strategically analyze all of your holdings and you dig deep for the tax consequences and the tax strategies and the income strategies that you take, you may decide to phase yourself out of your IRA over 1 year, 3 years, 5 years, 10 years, converting to a Roth IRA, which means you have to pay tax now on the portion that you convert. But it also means you're cleaning up your accounts for the benefit of your beneficiaries and yourself, possibly. When you look at all these different asset classes, some people exchange money into life insurance. They'll actually exchange money out of IRAs, pay the tax, rebuy it into life insurance, leverage up the death benefit. They might put $100,000 into life insurance, have $150,000 or $170,000 death benefit. So they've leveraged back the asset that the kids inherit or the spouse inherits to offset the tax that they had paid and not cause a tax consequence for their heirs, because life insurance done properly is income tax free. If it's really done properly, it's also estate tax free. We get into all this type of planning and we forget long-term care. Hey folks, if you're the kids and you're 50, and you've got parents that are 70, or you're 40 and you've got parents in your 70s, you say it's not time for long-term care insurance yet because you're in your 40s. And I'm telling you, yes, it is. But it's time for your parents. You've got to wake your parents up to, hey, mom and dad, if you go into a nursing home, one of us has to quit work to take care of you because we love you so much. We're going to buy long-term care insurance to protect ourselves from having to take off work to take care of you, so that we have enough payment to be able to provide the type of care that we want you to have if your parents can't afford it. Let's wake up and make this a family issue across generations. This retirement planning is complicated. It's difficult to do. It requires skilled attorneys, skilled CPAs, skilled certified financial planners, and skilled insurance advisors. Folks, we do this. We do this all. We work as a team. Give us a call. This is the type planning that we do. Most people are missing, and it needs done before it's too late. Again, you can give us a call. It's 412-833-1500. Extension 105 is my extension, or anyone in the office can help you. Please subscribe to our email list. I send these programs out on recordings to all the email recipients. I appreciate your tuning in, and we'll be back again next week.
Securities and investment advisory services offered through SagePoint Financial Inc., member FINRA SIPC, and registered investment advisor. Insurance services offered through Driscoll Insurance and Financial Services Inc., which is not affiliated with SagePoint Financial Inc.